The final panel is ESG is no longer a fringe concept. I think we know that. I got told off by Rebecca earlier on. Sustainable investing post-COVID-19. What is the impact on asset management? And this is going to be moderated by our very own Rebecca Healy. Thank you.
Good afternoon, and thank you very much, Vicky, for that introduction. And thank you to my panellists for joining me today on what is can only be described as a very hot topic currently. So we have Ty Galesh, who's Executive Director of Healthy Markets USA, and I'm sure you have much to add to the debate today, given everything that's going on with the CFTC and, of course, the SEC. We have Patrick Carlson, who is joining us as the Policy Officer at ESMA, in charge of ESG, so not too small a task at the moment, Patrick. We have John Marsland, who is Head of Data Enablement and Trading at Schroders Investment Management. We have Natalie Westerbaki, who's Director and Head of European Public Policy at Fidelity International. Thank you very much for joining us. And finally, but by no means least, a lady who's been at the forefront of data gathering, Turan Renahammer, who's Senior Account Manager at CPD. So thank you very much. Now, we really want your involvement in this debate, given just what a hot topic ESG is. So we'd like to ask you to go to slido.com hashtag FixEMEA2020, as always, to answer the first question. And our first Slido question today is, where do you actually see the ordering of issues? Is it E, S or G? Now, while you're putting in your all-important answers, we want to just go back to the panellists. Now, we had the MEP Paul Tang. He was talking about this morning that the policy needs to move harder and faster to meet the reduction in carbon emissions. And really, what do you see happening in that space? Why exactly is everyone interested in ESG all of a sudden? And Natalie, can we kick off with you? Why are your clients interested in ESG strategies?
Yes, absolutely. Thank you so much. And it's an honor to be on the panel. So the ESG agenda is rising so much in importance here because in Europe, we obviously have this conviction that the climate change is real, that it's partially man-made, and that it's urgent. So many of the EU countries and the European Parliament had declared a climate emergency. Now, with the COVID crisis, we also learned from the World Health Organization that since decades they've published reports that there is actually a link between the climate change and the outbreak of global pandemic. So it makes it even more important from a policy perspective that they focus on it. Well, luckily, they had already started drafting extensive sustainable finance policies over the last years, and which are now coming into place, just timely, so that the industry can implement them. However, even before that, it was very important for our investor clients. So we are a global asset manager, and the more and more requests came in to ask what are our ESG capabilities, because the fact is then that we started to develop at Fidelity an internal proprietary ESG rating tool. So we assessed all of the corporates that we invest in on a KPI with regards to their environmental behavior, their social behavior, and their governance structure. And
okay, so sorry, Natalie, can I just stop you there? Because I also want to bring in John from a Schroders perspective.
Yep.
Because I think one of the things that I find really interesting in the conversations that we were having with global asset managers last year was just how across the board it was. Because John, do you have a similar process at Schroders? Is this really being driven by end investors now?
I think it's a mixture of things. We've had an approach to sustainability and ESG matters at Schroders for well over 10 years. And I think whilst the emphasis has changed between the E, S and G in recent years, I think we've always felt that it was an important part of how you design an active portfolio management approach. And looking at this sort of data adds to your understanding and enables you to pick better companies. But I think the client demand has really taken off in the last year or so.
Yeah.
And what's so surprising is it is across all asset classes, it's across all geographies, but it's subtly different in different places. I'd say the emphasis between the E, S and G is different depending on who you talk to. It's such a wide set of different values that we're trying to encompass with this topic. and within it, there are many, many different sort of reasons why clients are looking at it to match up with their own values. I think the other thing that's understated is the need to do this from an employee perspective. I think in terms of engaging our staff and giving them purpose and so on, people in the industry want to feel that they are doing good and they're contributing. And I think it's very important from our own staff's point of view, and the way that we get and acquire the best talent in the industry is to adopt these sorts of techniques as well.
All right, and can I just bring you in, Ty, here? Because obviously, you know, we keep hearing that ESG is being driven out of Europe, and there's a lot of climate change. We've actually got, interestingly enough, we've got a spell check error on our first Slido question. So we've actually got ethical is 56%, which of course is environmental, so that's a glaring error there. I can only apologise. Social 22% and governance 22%. But Ty, can I bring you in here, because clearly in the US, surely climate change is driving. We've only got to look at some of the horrific scenes that we see on the West Coast for people to really begin to understand just the impact that climate change is having. And it's not just on something that's happening in a distant country, it's actually happening on your own doorstep. Do you think that that's driving end investors' appreciation for the need to start looking at sustainable investing?
Well, absolutely. And thanks for the question. And again, thank you for hosting me on a Friday afternoon panel. So I appreciate the opportunity. One thing I'll say is we have a massive disconnect in the United States between what's happening in the regulatory realm and what's happening in the asset owner and asset management realms. Asset owners are, be it they pension funds, foundations, or individual retail investors, are caring more about ESG factors than ever before. And again, I think as John alluded to, it's a diversity amongst the various different values as to whether or not they're prioritizing climate change, or whether or not we in the United States are having very significant, very real discussions regarding diversity and racial relations and worker power and those types of things as well. And so we have asset owners and both the pensions and foundations, but also individual retail investors are driving decisions and driving ESG investing. At the same time, we have a regulatory apparatus that is directly running counter to that on sort of a political framework. And we'll touch about that a little bit later. So the answer is absolutely yes. It is being driven by investors. It is being driven by demand from, frankly, people like me and my 401k deciding, gee, I'm looking at California burning and we have to save our planet. Yeah, absolutely. So on that note then, I think one of the things that I now want to go back to sort of talking to the people responsible for implementing this. So again, bringing Natalie and John back in, you know, what do we do here? Because for organizations such as yourselves, you know, Fidelity, Schroders, you're global asset managers. How does this actually work in practice? Because ESG as a standalone niche investment strategy was one thing. Taking that from a niche strategy to right across all your portfolios, how do you do that successfully? I mean, John, can I ask you a question? What does that do for your data alone?
Yeah, so it's a tsunami of data that needs to come and is coming into the business through ESG. And I think that the other thing that's interesting is that traditionally these sorts of data sets have been research data sets rather than data sets that we've used for operational purposes as well. So we've had to both productionize and scale data infrastructure and use techniques that you would probably more normally associate with quantitative investing and data science in order to service these sorts of requirements. And we're focusing on the raw data, our own models, which we want to use to talk to our clients about how we invest, as well as the third-party data. And we need to see that in many different places, in many different systems across the firm. So it's really about enabling, if you like, those downstream systems and making sure they can see a full picture of that ESG data. As I say,
So
it is a torrent of data that's arriving.
Is it more then around the communication between different divisions within your organisation now, just to get the right data to the right part of your organisation?
Yes, and the consistency as well. So I think we want to tell this story through the lens of our own models, which aligns with the way that we invest. But we also want to enable clients to compare our portfolios to other people's portfolios using more standard third-party data metrics and ratings as well. So we need to do all of those things at once, and it creates a number of different viewpoints from different fund managers, product managers, and so on within the business, looking to position their funds to make sure that they are highlighting both the more the ESG trends that people want to see in portfolios, but also the way in which those ESG trends are fitted into their active management approach as well. We want to retain the culture and way of investing, and we want to do that primarily through our own models and the way that we invest, and improve that as we have been doing for many years.
Okay, all right. So Natalie, can I bring you back in here? Because, you know, you were talking about the fact that it actually led you as an organisation to put your own model in place. You know, how do you manage it? So is that a necessity for firms, or do you think that actually you can work with third parties, or does it have to be a mesh of the two?
Well, both models are possible, and also hybrid model. What happens for Fidelity is that we are known as an active asset manager. So we have the in-house capability already with a substantive in-house analysts and investment professional capability. So they assess each company and the data they provide directly. They take also external third-party data providers into account. And with the new rating tool that we have, they will use guidance also, of course, from the policies, the EU taxonomy, but the SASB, so various frameworks globally. But what is most important is that they actively engage with the management of the company to validate the information that they have, because data isn't just objective, it's also how do we subjectively assess these metrics, and what ratings do we give them? Is it how does one company compare against another? Because obviously they don't operate in a vacuum. It's all comparative. And it's ultimately the valuation that we do on them. And this is for active manager sort of the way to help corporates also to transition with their climate change behavior.
So more of a stewardship role we're talking here.
Stewardship role, that's exactly. So, but of course, for others that don't have in-house capabilities, they can buy that outside, but it might be more challenging. So for us, it's an incremental step to add ESG criteria of something we've been doing all our lives already.
Okay, so
of course,
Torun, if I can just bring Torun in here now, because she's obviously a data provider. And Torun, you've been involved in this for a long time. And what are the challenges that you see? Because in effect, you've got to get this information from companies in order to be able to provide it to asset managers. Is this data always there? Is it consistent?
So CDP has been gathering data from companies for almost 20 years now, and we do that on the demand from investors. And now, of course, many companies now have very good ESG disclosures, but still after 20 years, many companies don't actually do that very well. So there's lots of more work to be done. And I would say that the ESG data is often called non-financial data, but I've heard another definition, and that is pre-financial data. So actually, by using ESG data, you can better predict also the financial future of a company, of course. So it's very good now that regulators in the EU, but also in other jurisdictions, have put focus on the importance of disclosure, I would say. And now, of course, the EU is now also using the financial sector to put pressure on the companies that they
To better disclose, yeah. Okay, so before we go into the new regulations, I think it's time for our next Slido question. Just to ask the audience, so what is your primary concern regarding ESG data? Is it the access, is it the accuracy, or is it the ability to incorporate that information into what is rapidly looking like spaghetti in terms of being able to get any analysis out? But while you are writing up your answers to the questions, I want to turn now to Patrick, who has the very dubious task of actually moving the industry in line with policy with the new disclosure regulations. Now, we had Paul Tang on earlier. I don't know whether you were able to join us for that, but it was very clear that he has a concern around, actually, it shouldn't just be environmental, it needs to be societal, and that's just as important, and that is at risk of getting left behind. So what role will the new disclosure technical standards that, you at ESMA are forming part of the ESAs to be able to provide this, how are they actually going to be applied to market participants? Because it is quite complicated, isn't it? You've got entity level disclosures, product level disclosures. How's it actually going to work in practice?
Well, hopefully really well. Obviously, we believe in the legislative framework that, we're working with. So yeah, just a few words on this topic is a good idea to kind of set the scene. So it all started with the action plan the Commission set out in 2018. And there was, 3 key planks. The benchmark regulation that's already been in place, the taxonomy regulation, putting in a framework for designating what's an environmentally sustainable activity, and then the disclosure regulation, which sets out rules for the financial sector to disclose their activities and the impacts that they have. And it's this last piece that I've been working particularly hard on as one of the ESAs. ESMA is, as correctly said, one of the ESAs working on this. This is a joint committee project between ESMA, EIOPA, and EBA. Our role, of course, is relatively limited here. We are setting out level 2, so to speak, level 2 rules, the technical standards to the framework, and we're only giving rules where we are empowered to do so. The level 1 regulation itself has a number of obligations on financial firms including asset managers, banks and investment firms that do portfolio management, insurance companies, pension providers as well. So rules about what firms have to do in terms of disclosure. There are certain level 1 provisions like the disclosure of sustainability risk and how it's integrated into policies. There's a disclosure around remuneration policies and the impact of sustainability in that. And then there are some very significant rules at the entity and product level where we have a role in creating some technical standards to underpin these framework rules. So if we start at the entity level, this is a relatively groundbreaking transparency requirement in the disclosure regulation on the principal adverse impacts that investment decisions have. This applies on a mandatory basis to financial market participants, so these firms that I was talking about with 500 or more employees. And it is a comply or explain obligation for firms with fewer than 500 employees. This disclosure has to account for the principal adverse impacts of all the investments made by this particular firm during a reference period, which is usually a year.
Okay, so can I just stop you there, Patrick?
Yeah, of course.
Can you just underline that fact? It has to be for every investment. I think this is what people don't understand.
Yes, that's right. There's no definition of investment decision in the level 1 text, and we're not empowered to give any further definition to that. So it therefore applies to all the investment decisions made by the financial firm, and that's the entire firm, not just any one particular unit to it, but at the firm level, everything taken into aggregate, all the investment decisions made during a reference period.
And also to the other point that you made about sort of 500 employees or more, that actually applies at the group level rather than the individual firm, correct?
Well, it depends where the 500 employees are. If the entity that has 500 employees is a subsidiary, then it applies on a standalone basis to that. If it's part of a group with 500 or more, then it applies at the parent level. And then the disclosure has to be made at the level at which there is 500 employees. Basically.
Okay, so there are significant obligations in terms of firms of what they now need to do. The other factor that I think is very important to stress is just the timeline that firms now have to, and I realise, ESMA as with all European regulation, in fact, all global regulation, it's been a lot harder because of COVID-19. But, you know, is there really bandwidth to push back at all on when the obligations need to start, or should actually market participants start thinking about the fact that this needs to come into play March next year?
Right. So, yeah, indeed, as a European supervisory authority, we have no power to change the application deadlines of the level 1 text. That will be the 10th of March 2021, as it currently says in the regulation. As some may know, we have been relatively open about the fact that we have requested that the Commission review this particular deadline, not least in light of the fact that due to the COVID crisis, we had an extended consultation period for our technical standards, meaning that we have let the Commission know that we will likely be about a month late in delivering the final report with our regulatory technical standards. So that would be January instead of December. So certainly,
okay, but
the
it's
view
not
of the East.
it's not a huge amount of wriggle room here. I mean, we are looking at having to implement something relatively quickly. So what I would like to do actually is just bring, if I could just bring John back here in terms of, you mentioned earlier, John, it was a tsunami of data. Now, if we're looking at these disclosures, you know, that is actually going to ratchet up the amount of data that you're going to have to look at.
Yeah, I think it depends on getting exact definitions on the data as soon as possible. The real issue is with regulatory data is it has to be very specific, and we have to completely understand what it is that we are being asked to report on, because obviously we have potentially hundreds, if not thousands, of funds and share classes to report on. And obviously that's quite a sort of significant production undertaking. But much of the data we already have, it's a question of nailing down exactly which data items, because there are many data items for each topic which could be applicable. And I think it's getting to that level of specificity that's the real issue as quickly as possible.
And Natalie, do you have anything to add here, just in terms of those data challenges for a global asset management firm such as yourself?
Yeah, no, I definitely think it is a challenge, but I think it's industry-wide, not just asset management, it also impacts banking sector, insurance sector. It's a journey. We need to learn across all the financial services sector how to do it and how to do it the right way, but also we need to obviously try to do it as quick as possible, given the challenges we described at the beginning of the panel.
Yeah. Okay, so let's go back to our Slido question. The question was, what is your primary concern regarding ESG data? Was it access, accuracy, or the ability to incorporate that data? And we are looking now at the results. It's accuracy. So 80% of participants saying it is the accuracy of the data that's currently available that is their primary concern. Turan, as a data provider, I know you have strong views on this. I mean, is that a huge surprise to you, given the challenges that you have in getting the data from companies?
No, of course not. It is a challenge, definitely. And as I said, not all companies do report very well, but there's also this, as John was talking about, the specifics. I mean, what exactly, which data points will you really need? And of course, the challenge that we will need maybe different data points in different jurisdictions, because the taxonomy, for instance, that the EU has now on the table is there are other taxonomies for environmentally friendly investments in other jurisdictions. So that will be very complicated both for companies and for investors to report correctly on this. And of course, another challenge is the different asset classes. I mean, we usually talk here about listed equity, which is comparably simple. But if you look at other asset classes, then you're not looking at the company level, but you're looking maybe at a project level or at a bond level, or, it just gets very complicated to tie the right instrument to the right company and so on, and get the right data that is relevant for that instrument. I'm not sure exactly how that is going to work out.
And also, can I bring in John here, because you mentioned earlier this whole idea of sort of portfolio trading, and if you're taking it at the individual investment and moving it across portfolio trading, how is that going to work in practice?
Yeah, I think a lot of this data makes sense to an individual company or to an industry, but it doesn't necessarily make sense to combine it at the portfolio level, certainly not without a lot more modeling. So a lot of the metrics we get are industry or sector neutral, but actually there's limited value in when you look at a whole portfolio when you combine those metrics together. So it's a real challenge, if you like, to get that portfolio effect from many of these measures, some of which only apply to some industries or much more important to other industries. And you can see that when you look at things like SASB, the standards board, they have a materiality matrix where quite often a lot of data sets aren't applicable to one or two industries.
Okay, and so what do you think the potential unintended consequences are here? I mean, is there a risk that, we talked about earlier about, when you're actually rating firms, if you're rating them on ESG, do you inadvertently sort of knock out one company that potentially is trying to do better on their ESG scoring?
Absolutely. There's a difference between ESG rating and impact as well. So some companies, for example, take a company that might make wind turbines. Wind turbines use an awful lot of steel and an awful lot of concrete to make them. But obviously they're going to have a positive impact on electricity supply from an ESG perspective. But on some measures, they might look pretty bad because of the inputs they use to do that. So I think there are many, many different lenses that you need to look at companies through. And often the true answer is much more subtle. And that's why we need more models, which and especially models that fit the investment approach, that allow us to show our clients what we're doing and how the positive impact is being delivered on, if you like, the planet, the people, and general prosperity for people generally.
Okay, so can I, Patrick, can I bring you back in here? Because I think this is one of the challenges that asset managers that we've been talking to clearly face. Because there's one thing when you're talking about your policy around ESG and the factors that you take into consideration. And that's obviously something that you're asking people to put on their website, so it's very clear, so end investors aren't confused about how a certain asset manager is approaching their ESG strategy. But again, to John's point, how it's the disclosures on that certain set of criteria. In some senses, that again, going back to a comment that you made earlier, we've got to start somewhere. We've got to get that data from somewhere in order to get going. And we shouldn't hold back just because the system isn't perfect currently. But what would you say to those who are saying, we need to get the data right first before we start?
Yeah, no, I mean, we're certainly aware among the European supervisory authorities that data is an issue in terms of quantifying the impact, because that's what we're dancing around here, essentially, that ESAs have proposed in the consultation paper we issued in the summer, a kind of indicator framework where you have a number of indicators to which everyone has to report, of the ones reporting principal adverse impact, have to report the impact of all their investment decisions. Now, that's obviously different from just saying what your policy is about finding impacts and addressing them. We do also require that, as you quite correctly pointed out, but we have also interpreted the empowerment that we have under the level 1 regulation to define these indicators and be relatively granular about them as well. Now, we proposed 32 different indicators, and we have received a lot of feedback in the consultation that closed on the 1st of September about the feasibility of reporting against them, the usefulness, the added value, and the comparability of reporting against them. Now, obviously, we're taking our time and analyzing the feedback appropriately before we come out with any conclusions in the final reports, which, as I said, is due in January. But yes, you did put it quite correctly, Rebecca. I think that we shouldn't discount a principal adverse impact just because there is no data about it. In other words, we are aware that we shouldn't be limiting the framework simply because there isn't sufficient data currently available. We are also trying to create the demand for that data through our indicators. Obviously, we have to take into account the language of the level 1 text, for example. There is something there of proportionality. So I think we're taking into account the comments that we've received, and we're considering carefully the next steps here in the final report.
Okay, thank you. And Natalie, can I bring you back in here? Because again, you know, are there some unforeseen consequences here that asset managers or insurers will start to say, do you know what, we're not going to touch that because it's just becoming too risky an asset or the ability to insure? I mean, are there unintended consequences here where the universe of investable stocks or assets begins to shrink?
I don't see that risk imminently, because I think at the moment the intention is simply to measure, so to integrate these factors. But what's becoming more and more evident as more and more asset managers develop, like Fidelity, their own proprietary rating tool, is the fact that there is a true correlation between these so-called non-financial ESG factors and the financial performance of them. So we, for example, identified over the last 6 months that those corporates that we had given a good ESG score through our internal assessment have on average suffered less losses, hence have outperformed. And I think that's what's more driving really the interest of our clients and our end investors, is the downside protection that it brings with it when we include ESG factors. So policy is one driver, but the even stronger driver comes from the end investor themselves. So policy is helpful because it's almost like enabling us to find common definitions, ideally not just in Europe, but beyond. So it's good that there is sort of an international coordination effort.
On that magic word of international cooperation, I need to bring in Ty here, because obviously we've had a very strange set of circumstances coming out of the US, which I know that you are front and center of. Can I just get your take? Because it does seem quite confusing from a US asset manager's perspective, just exactly what they're supposed to do right now.
Well, I think that's exactly right. So let's, I'll share the stage, because this is a fascinating discussion to have, because it's so disconnected from the regulatory discussions that are occurring here in the United States. So let me start with the basic, a couple of data points. So in 2019, our Securities and Exchange Commission began examinations and investigations of asset managers for integrating ESG factors in a way that potentially would be inconsistent with what they had disclosed. So when we talk about the accuracies of disclosures and we talk about how integration happens, the primary focus of our regulatory bodies right now are twofold. The Securities and Exchange Commission is primarily concerned with what we might otherwise call greenwashing. The idea of asset management saying that they're following things like the UNPRI principles or those types of things. And in fact, that's what the SEC was investigating. They were looking at firms that are signatories to UNPRI and then saying, hey, are you investing or are your policies consistent with what you say as a signatory? The other concern is essentially what our Department of Labor is doing with our pension plans and our 401k individual retirement accounts here in the United States. And in that regard, they're basically saying, hey, you as investment fiduciaries should not be examining anything other than the immediate pecuniary best interests of your beneficiaries. And so
I think that's what's so interesting about Hester Peirce's comments last night when she was talking about, and there is an element to the concerns that we see in Europe about greenwashing. So her comment about the ESG or the asset managers who talk the ESG talk but don't walk the ESG walk, you know, that's number one. But also the comment she made that she was surprised by the response from US asset managers about the Department of Labor's ruling. If the ESG performance is so good, why would that not be a factor?
So the way that the Department of Labor sort of went about it is essentially it used to be, hey, all things being equal, you can still be engaged as an asset manager or as an ERISA fiduciary. And what they've essentially done is limited that, or proposed limiting that, all things being equal test to a very concrete sort of immediate pecuniary benefit test. And they've even gone so far as another rule proposal to actually prohibit ERISA fiduciaries, including asset managers, from even being able to vote on proxy proposals and things that may not be, again, immediately pecuniary benefits to the beneficiaries. So we have...
You roll that back with the CFTC, you know, and one of the things that struck me in the report was, you know, when Paul Tang was speaking earlier today, he was talking about we have to put a price on carbon. So what's the first recommendation in the CFTC report? We need to put a price on carbon. You know, so there are similarities here between global regulators.
So I would make a distinction. What we've seen is actually the Trump administration regulators are united in the approach of sort of prohibiting ESG consideration until or unless there's an immediate pecuniary benefit to the beneficiaries. Right. And what we've seen separately is the advisory committees. Those are private enterprises, including some folks here, many of your members as well, who are tasked with helping our regulators, informing our regulators on issues. And so the CFTC's advisory committee, that is a private group that advises the CFTC on what to do. The investor advisory committee at the Securities and Exchange Commission, similarly. They are saying, look, we need to be considering these things. We need to have better data. We need to be incorporating these things into our fiduciary duties. We need to be integrating across our products. And so it's interesting. So the CFTC report is actually not a CFTC document. It is an advisory committee to the CFTC. And the SEC has its own investor advisory committee and an asset management advisory committee, both of which are also similarly oriented, saying, look, we, the United States, should be catching up with, frankly, what the rest of folks like ESMA, in fact, is doing. And maybe not in the exact same way, but certainly more in that direction than the direction we're going. So for us in the United States, the very big distinction is going to, frankly, turn on an election in November. Because I think if the current administration stays, I think we'll go see even more of this sort of prohibition of ESG considerations sort of going up. And then I think if we see a change in administration, I think we'll see a quick reversal of, frankly, a lot of the rule proposals we're seeing, and frankly, more alignment with ESMA and the rest of Europe and the world.
One of the interesting things in the SEC, so the SEC had an advisory roundtable this week on Wednesday, and one of the comments that came out there was actually should asset management firms that say they do ESG actually be monitored for ESG themselves, which I thought was even more stark, just in terms of where this potentially could take us. And that actually brings us to our final polling question, where we're going to ask you, the audience, do you see ESG as a firm-wide issue, or is it still just relative to your ESG team as a separate part within your organisation? So Ty, sorry, do you think that asset management firms are becoming more aligned with ESG themselves? Is this something? It's bigger than actually industry. This is just part and parcel of the fabric of our society now.
Well, that's right. I mean, look, you've got folks who can speak more internally to their own institutions also on this panel. But what we can see is looking at the comment letters that we're seeing to the regulators. So the regulators are saying, the Department of Labor and the SEC in particular are looking to decouple, deintegrate ESG from a firm-wide approach, or otherwise somewhat frustrate the consideration unless there's the direct, immediate pecuniary impact. And global asset managers, and not just global asset managers, but asset owners in the United States, you can think of large pension funds and others, are saying, oh my goodness, no, we want to be going in the opposite direction, if for no other reason than regulatory simplicity. Essentially what we have proposed is, in Europe, as you just heard from Patrick and others, an ESG integration model framework that asset managers who are operating there are going to be doing. And at the same time, you have a proposal in the United States to prohibit the exact same practice.
Yeah.
And those two things are going to be extraordinarily difficult to reconcile for, frankly, two of the firms you have represented here today. And we've seen that in the comments.
Okay. Right, well, we've got 5 minutes left to go. If anybody does have any questions, please do send them in via Slido. And before we get to the responses in that last polling question, I think what I want to ask the panelists is, you know, we've heard about the challenges, and hopefully we've also heard about some of the opportunities for the industry to deliver on this. But what do you think, where do you think FIX can help in this process? Because there clearly needs to be a greater level of harmonisation in terms of those data disclosures. John, can I ask you, from your experience of FIX thus far and your role as sort of head of data within Schroders, do you think that there is a role for the FIX community in helping you sort of understand some of the spaghetti of information that you're now going to have to be facing?
I think one of the challenges in the data is there's such a lack of standardization. And I think that's where FIX has helped. If you look at the way that trading systems are connected, FIX has completely transformed the ability to connect and the ability for a diverse set of partners to connect as well. And I think standards around things like reference data, security master data, how we map corporate entities, how we decide which piece of information applies to which entity in the firm is incredibly important and will be critical to this process. And I think FIX could help in that sort of data reference challenge area in terms of specifying the standards.
All right, we've certainly set us some important homework, but Torren, can I ask you, is there, given there are so many bodies that are involved in ESG, but do you think that there is something that we need to do here in terms of developing industry best practice in terms of how you integrate with all these various different bodies? I mean, you've obviously written a report recently, or your firm has written a report recently about talking about how these different bodies can integrate with each other. So there does seem to be hope and optimism here that it's not all doom and gloom.
Yeah, I think that some of the confusion is because there are so many different bodies and so on. But the truth is that they do different things and they all fit together in various ways where we need a little bit of everything, so to say. And this is, of course, a process that is running since not so many years. And I must say that for financial accounting, for instance, I mean, it took very long for that to become standardized. So we have to have a bit of patience here. But of course, I think that, for instance, the EU Commission, of course, is looking at this because of the regulatory developments. So. And other people are looking at it too. So I'm sure that there will be more standards. But again, I will also second John, because I think sometimes the last step is lacking. I mean, that we look so much on a company level, but the truth is that we have to look at security level, etc. And that is much more complicated.
The boring but essential, as they say. So in terms of the polling responses, if we could just get that up on screen, it's very clear that we've got it's firm-wide. So ESG has definitely moved from niche to mainstream. I'd just like to thank my panel very much. Can I just ask you, if there's one thing that you would like industry participants to address in the next 12 months, Natalie, what would that be?
Yeah, I think, and it goes back to your question on fixed trading community. So this type of platform that you've set up for today is really important for collaboration, so that we learn from each other how we actually implement. And there will be lots more news coming from the policymakers. So we need to increase our understanding, but also exchange on practically how we're implementing it. So that would be my recommendation.
Thank you very much. Patrick, one final word from you, if I may, just in terms of what you're hoping for in the next 12 months, other than everybody to complete their disclosures on time, obviously.
I was just going to say comply with the rules. I guess.
Well, that's an easy response. We'll have to do our best to make sure that happens. And Ty, from the US, your final word?
I think it's, again, connectivity. I urge you, frankly, the United States is home to many very, very large firms, and our regulatory regime will either support or frustrate your efforts. So I encourage firms to engage here in the United States with our regulatory bodies, so that we are essentially not a drag on progress.
Thank you very much indeed. I would very much like to thank my panelists. That was extremely useful and insightful. Thank you.